Why it's not letting me drag it over to my second screen. Hello, class. Just getting in the classroom, getting ready to start your lecture video for chapter 6 here, where we're going to begin talking about inventory. I'm having some technical issues here. I'm trying to utilize my double screen, but it doesn't seem to want to be working. But that's okay, because I'm going to be using a PowerPoint for this anyway. So let me go ahead and get that pulled up, and I'll just share my screen and we'll get going here. All right. Actually, let's do this. I got to share my screen first. And now we'll take it into a slideshow. All right, so we're going to start talking about cost of goods sold and inventory in this chapter. So in chapter 4, we kind of talked about cash. We did a lot of cash and internal controls there. In chapter 5, we talked about receivables, another current asset. Okay. We have other current assets like supplies and prepaid that we kind of covered in chapter 3 when we were doing adjusting entries, what they were. So chapter 6 is our last major current asset here. We're going to be talking about inventory. Okay, inventory is when we buy and resell goods. So we're going to focus on, when we get into inventory, is the different types of inventory that we have for different companies. There's a couple different types of inventory systems, and then there's 4 different ways to actual measure or put value to our inventory. So we're going to look at those 4. Okay, so that kind of goes to our learning objectives. So what is inventory? Okay, I'm sure you've all heard the term inventory. Is products held for resale and classified as a current asset on the balance sheet. Okay, so it's something that you buy that you intend to resell in the future. Some companies, it's a lot, they have a lot of inventory. Think about Walmart, you go in there, almost everything they have in there, that inventory account would be huge because everything in the stores for resale. Whereas Microsoft, they sell products, but they only make enough iPhones to sell. You know, they don't have a big stock just sitting around waiting to go out. Okay, so their inventory becomes a lot smaller compared to the other current assets. Okay, when we sell inventory, so when we're going to go out, we're going to buy inventory. It's not going to be an expense to the company to purchase inventory to resell. In order to meet that matching principle for revenue recognition, we're actually not going to expense that inventory until we sell it. We're going to do it through an account called cost of goods sold. Okay, and that is, like the slide says here, the most important expense of the income statements for companies that sell goods instead of services. Okay, that is known as your gross profit. Book likes gross margin, I call it gross profit. That's what I grew up with. It's a key performance measure. If you're going to be a manager in the outside world and you're going to get bonuses maybe on your work someday, they're going to be basing that off what the gross profit is. Okay, because that gross profit is that cost of goods sold. It is what you can control as a manager, as you're going to see as we start talking about the valuation methods and the different types of inventory systems. No matter which one you're using, you know, theft and waste and stuff like that comes into play that affects the cost of goods sold, that hurts that gross margin. So, and labor time even goes into there. Okay, so that's the stuff the manager can control. So gross profit is a key number. We need to remember that gross margin or gross profit is revenue minus cost of goods sold. And that cost of goods sold is the expense account for the inventory that had already been bought that we have just resold. Okay. What I said there. Okay, we run a sports bar, concerned about low gross margins on drinks, and the new bartender, you secretly mark the levels of the wine and liquor for a week. You check the bottle level and the register record for the number of drinks sold. Okay, if you find more drinks are poured than the register showed, which of the following is not likely? So what do we have here? We have a bartender that's kind of giving away free drinks, don't we? Okay, we did that because we marked our inventory level. We look in and we can measure or weigh the bottles. And say that the cash register brings in drinks where we should only use 8 ounces of rum. When you look at the bottle, there were 16 ounces of rum missing, okay? Bars can lose a lot of profits that way. What is actually happening in that situation? Okay, were drinks sold for cash but not entered into the register because the bartender pocketed the cash? That could have happened. Okay, that would cause extra inventory to be gone but not shown on the register. Both food and tips are being recorded as drink sales in the registers. That's probably not right because the drink sales is what we're looking at. If we added food and tips on there, our drinks would be higher. So we wouldn't notice that missing booze. Friends of the bartender serve free drinks, that could happen. And the bartender has a heavy hand and over pours on a regular basis, that could happen. Okay, so to answer these questions, which of the following is not likely? Well, A, B, and D are all reasons why our liquor bottle is coming up a little bit short, but C is the one that is not. Or B, or is the one that is not. Sorry, I said that wrong. When we were explaining it, that's what we talked about though. Okay, option B is the correct answer. All right, so it's gonna get us into inventory. I said, no, we're gonna talk about the different inventory types, costs included, which inventory systems, how do we record these transactions, how do we compute cost of goods sold, and the financial effects of the 4 inventory costing methods. How exciting. All right, so types of inventories. Okay, for the rest of this chapter, we are going to be talking about merchandise inventory. Okay, merchandise is where you are buying something from another company and you either in turn to turn around and sell it to the public. Okay, that would make you a a retailer. Okay, or whether you are buying from another big company. No way, that would make you a wholesaler. Get my words confused there. Early in the morning for me up here. Okay, so if you are buying from one company and you are selling to the public, that makes you a wholesaler. Or you're selling to the public makes you a retailer. If you are buying and in turn to sell to another business, that makes you a wholesaler. Okay, doesn't matter what kind of merchandise you are in this company, we're going to look at it from both sides' point of view at some point in time when it comes to inventory costing. Okay, how much inventory is coming in for them, how much is going out for them. Okay, but we're going to focus on these merchandising companies. Manufacturing companies, when you get to accounting 2, we're going to talk all about how to account for raw materials, work in process, and finished goods inventory. Okay, and then once everything is manufactured, then when it gets sold, it goes out as cost of goods sold from finished goods. Okay, so that is the primary focus of accounting 2. This is a cost flow diagram for what you will do in accounting 2. A manufacturer as the raw materials, direct labor, manufacturing overhead. Except for the rest of the chapter, we're not going to worry about it. We are going to have one account and we are going to call it inventory because we are buying it from one business to either sell to another business or to the public. Okay, so no matter what method we decide to do here, okay, no matter what type of system we decide to use or what type of costing method we decide to use, this cost of goods sold model is something that you need to know. Okay, you can write it out in a mathematical form, and when we get to the question, you'll see it. But it is your beginning inventory plus purchases. When you add those together, you get your cost of goods available for sale. Okay, I call that COGA, C-O-G-A. Okay, your COGA, your cost of goods available for sale. When you subtract out your inventory, you get your cost of goods sold from your, so COGA minus inventory equals cost of goods sold, or your COGS, C-O-G-S. From your cost of goods available, if you subtracted out your cost of goods sold, you would find your ending inventory. Okay, so no matter what kind of information, if you're giving 4 of these, you can kind of plug in and find the other one. It's beginning inventory plus purchases equals cost of goods available for sale. And that goods available for sale is either expensed as cost of goods sold, or it remains in your ending inventory. Okay, so here's an example of that. We have beginning inventory of 26,000. The company purchased goods from a supplier costing 411,000 on December 31st. The cost of the unsold inventory was 38,000. Whoops. So we take our beginning inventory plus our purchases. 411 plus 26,000 gives us 437 as our COGA, cost of goods available. Subtract out the ending inventory that we went in and counted, 38,000. So we find that our cost of goods sold for the period were $399,000. Okay. And the bottom example is going through the exact same problem, but it's just telling you that if we knew going in, instead of giving the ending inventory, we knew what our cost of goods sold were $399,000. We could plug that into that same formula there and come up with our ending inventory amount of 38,000. Okay, you're going to be using this a lot. Okay, so it's good to remember this formula. Okay, there are two different types of inventory systems. I'm going to start with the one down there on the bottom, that periodic inventory system. Cost of goods sold are recorded only at the end of the period because that's the example that we just did right before this. Okay, a physical count of inventory is taken at the end of the period. Okay, or you kind of estimate it, but you're going to have to need a number, and then you plug that in to that cost of goods sold formula to figure out your inventory. That's a periodic inventory system. Okay, cost of goods sold is only recorded at the end of the period. So if you record an income statement each month, at the end of each month, you'd have to do a physical count of your inventory. And then you would put that into the formula. You would know what you had at the beginning of last month, plus everything you purchased during the month. Okay, subtract it out. What you counted at the end of the inventory becomes your cost of goods sold. What becomes the problems with that? Inaccurate counts. Okay, and this is where managers can control a lot of stuff when I'm talking about that gross margin, which is revenue minus cost of goods sold, because we're making that count. So your inventory counts have to be accurate, but also if you had any waste or theft or damaged merchandise that's unsellable, okay, all that stuff, you're not going to count in your physical count of inventory. So it is going to get expensed as cost of goods sold when you make that count. Okay, and then there's the perpetual inventory system, which with technology, this has become more common. The cost of goods sold gets updated with each sale. Okay, it requires detailed records on a transaction by transaction basis for each purchase, each sale of inventory, and that's what the register does. It can, scan that barcode and it can update your inventory. Say, okay, we had 56 of this specific item. It came in at this price. Boom, when we scan the inventory of somebody buying it at the register, it immediately updates our system, says now we only have 55. Okay. And that is what most companies are using nowadays. Like I said, with technology, it's easier to keep those detailed records. Whereas your smaller businesses are going to use this periodic inventory system. Also, theoretically, if a perpetual inventory system updates with each sale, they should be equal, right? The perpetual and the periodic. However, again, one good internal control is to compare the perpetual inventory system to an annual periodic physical count of inventory. And this is what I was saying. Even if we're using this, one of the fallbacks of the perpetual method is you don't know. Lights went off here. I need to move around more. One of the fallbacks of the perpetual method is that you don't really know about what you don't know. You're just getting everything that goes to the register. So if there's shoplifters, vendor fraud, authority theft, okay, administrative or bookkeeping errors, okay. A lot of stuff is going to happen to your inventory. And if you're on a perpetual method and everything's getting run by the register, it just gets easy to just kind of rely on that technology. Be aware of that. That's why periodically you need to do a physical count. So even though you're using a perpetual, maybe instead of doing a count every month, you do it every 6 months or every year. And you have to make that adjustment to your cost of goods sold still. So that number is still going to the theft and all that is still going to get into cost of goods sold. Okay, it may be a little bit harder to detect under the perpetual method, but the perpetual does keep more accurate records of your sales, transactions, and your inventory as a whole. So what do you think is responsible for the largest amount of inventory sharing is? What about employee theft? Interesting question, huh? Employees account for 43% of inventory shrinkage. Person working at the gas station, the person working at Walmart, just taking something small home by themselves, thinking it doesn't matter. 43% here. Happens all the time. Okay. Accounting for the purchases of inventory. Okay, when we account for inventory, we have to use the historical cost principle, meaning that whatever we pay for the inventory, that's what we recorded the inventory at. Okay, but it is not just the cost of the inventory that goes into it. It is the purchase price of that inventory, plus any cost to bring the goods to a saleable condition at the company's location, or any, if you're going to finish the product. Okay. So other incidental costs we're going to talk about as freight. So transportation cost. If you have to pay the trucking company to bring inventory to you, you include that in your cost of inventory. If you have to pay insurance on it while it's coming to you, it is part of your inventory. And any sales taxes that you're going to pay on the delivery or the purchase of the inventory is included in a company's inventory and allowed to be expensed out through cost of goods sold. Okay. We are only going to account for inventory under the periodic method in this chapter. Okay, I think it is the appendix where it gets into, we're going to use the perpetual method. I think it is the appendix where it gets into the periodic method. And there is a different way to account for purchases and sales under the periodic method. Okay, and if you go on in your accounting career, you'll deal with that in intermediate accounting. But for the focus of this class, I only want to look at the perpetual system for accounting for inventory. Okay, so purchases refer to the cost of merchandise acquired during the accounting period for resale. Okay, so when we buy inventory, it's called a purchase. All purchases go into inventory account. Okay, when we go to record them, all purchases are going to increase inventory. All purchases should have that source document. So you should have a purchase order saying this is what we ordered. Then you should receive the invoice saying this was what was delivered. Okay, you match them up with each other. Make sure you got everything you ordered. You're paying the price that you said you were going to pay. Okay, just want to make everything from the purchase order matches up with the invoice. If not, have the reason down on there. And then remember, the cost of purchases must include any effect of discounts, returns, and transportation charges. Discounts. Sometimes we get sales discounts, right? So example, if we have a purchase discount with the terms of 2 net 30, meaning a 2% discount may be taken if we pay within 10 days. Okay, remember when we did that for sales, it reduced our revenue. Okay, if we pay back within the discount period, okay, and we know we're going to pay back within the discount period, we're going to record our inventory at that lower amount, the 2%. Okay, purchase return and allowances. So we have a right to inspect our purchases. If something does not meet up to our expectations, we have the right to get a hold of the seller and say, hey, we're going to return this the next time the truck comes by. Okay, or hey, this came damaged. We're not going to pay full price for it. We'll still take it, but maybe give us 50% off on the price. Okay. Whenever you get a purchase return or a purchase allowance, it always lowers the amount of inventory. Okay, the value of the inventory that came in. Okay, it's also going to lower the amount that we're going to pay them, so it'll also lower a payable at that point. Transportation costs. As I kind of mentioned in a previous slide, that transportation costs, if we pay for them, are going to become part of the inventory. This is the one time here where we're going to kind of look at it from the other point of view. If we're the seller and we have to pay for transportation costs, it becomes a selling expense. It's like a delivery fee, or you call it transportation cost, transportation expense. Okay, but it would be that kind of account. So in order to determine if we, the buyer, are paying for the shipment and including it in our inventory, or if the seller is including it as their expenses, depends on the contract terms, okay? FOB shipping point. Okay, the FOB stands for free on board. I don't understand why it is that. It's just its term. But shipping point is what we're looking for there. Shipping point means that is when the ownership transfers. Okay, so as soon as if A is buying from B, as soon as B puts it on the truck at their warehouse, that is a shipping point, it now becomes property of A, even before it gets on the road. Okay, they have ownership of that inventory. Having ownership of that inventory while it is traveling means that they are paying for the shipping costs. Okay, so they will include it in their inventory. Okay, FOB shipping point, the buyer pays the costs, right? Because they own it as soon as it gets loaded onto that truck. That is called freight in. Okay, that's what they're going to term it for us. We'll call it freight in. But it's going to go into the inventory account. When it's FOB destination, that means when B puts it in his truck and it travels all the way over there and it gets to A and it pulls up to that loading dock at business A, then it becomes business A's property. That is when the ownership transfers. Okay, the owner pays the transportation cost, so B owned it the whole time it was going to A. Okay, so they are going to pay the cost to ship. In that case, and we'll call that freight out, and that is a selling expense. Okay, consigned goods. Consigned goods is when someone gives you, if we're a business, it's like a pawn shop, okay? But only when there's no upfront fee. A lot of times they'll just come in a resale shop. Somebody's like makes bracelets and they take them to a shop and say, hey, can you sell these for me? All right. If you sell them for $10, I'll give you $1 for every one that you sell. As the business owner there, I didn't actually purchase those bracelets. I am just letting them sit in my shop. And if they sell, they sell. If they don't, they don't. I'm not out any money. But for everyone that does sell, I get $1. Okay, they have been consigned to me. Okay, that is not part of my inventory. Okay, if I'm going through and doing a physical inventory count, I'm going to make sure any goods that are consigned to me are not part of my inventory because they're not legally mine. They're not my property. They still belong. That person came back and said, oh, hey, I see you sold one. Well, that's good enough. And they want to take it out. They could. It is still their property. Okay. The perpetual versus the periodic. This is a good thing to study, to know, to understand the differences between the two. Okay. This is telling you how to account for the periodic system. Okay. Look through it, maybe kind of be aware for it. Especially if you're an accounting major. So when you go forward, you kind of seen it before. I'm not going to have any homework questions or any test questions where you're going to have to use the periodic accounting method. Okay, but this kind of shows how they differ. Under the periodic system, if we want to know our inventory in the middle of the month, we'd have to take a guess on our inventory or do a quick count. Under perpetual, it would be there immediately, but we'd have to add a little to it because of stuff we don't know about yet. Okay, recording purchase transaction summary. So inventory, we increase our inventory for whatever we pay for the inventory, plus if we pay any transportation costs. Okay. We're going to make our inventory go down if we get a purchase discount. Okay. So maybe we get that 210 net 30 in there again, we get that 2% discount, decreases our inventory. If we return it, or if anything comes damaged and we get an allowance, that is going to decrease our inventory. So here's an example. So when I'm doing an example here, I like to go through, let's pick out what we got. There is a lot of information here. So September 1st, Brandon Shoes purchased 50 pairs of hiking boots for $3,750 cash or $75 a pair. Stop right there. What do we have here? We have a purchase of hiking boots. The number of pairs is not important to us because of this monetary unit assumption that we talked about back in chapter 1. We're only worried about the dollars. So I'm going to write down here on my scratch piece of paper that we had a purchase for $3,750. Purchases are part of inventory. So I'll just kind of note that purchases go into inventory. Okay, moving on. And paid $150 of the transportation cost. Okay, so we are Brandon Shoes. We paid transportation costs, so we have 150. We'll write this down. Transportation paid. And I'll just draw a little arrow and say, hey, that belongs in inventory. All right. Also, on September 1st, Brandon's purchased 100 pairs of running shoes for $10,000. However, the seller paid the transportation costs of $300. Okay, so now we have another purchase of $10,000, which we know is going to go into inventory. The seller paid the transportation costs in this, so if we are Brandon Shoes, that is something we can ignore. Okay, it'll be an expense on the seller's end, but we do not need to do any recording for it. The running shoes were purchased on credit with 2 terms, 2/10 net 30. Okay, so we get a 2% discount if we pay for them. So Brandon paid for 1/2 of the running shoes on September 10th within the discount. Okay. So we put paid $5,000 within discount. After inspection, they determined that the running shoes were defective and returned them. So we returned, or write this down, returned 750 in shoes. And the remaining cost, 4,250, was paid on September 30th. Okay, so it gave us a lot of information there. So it's always important to go in and identify what we have first and break down the information, because there are actually, in this one problem, what I wrote down here, we have the purchase, the transportation, another purchase, a payment, something getting returned, and something paid. So we have 6 different financial transactions happening in this one question. Okay. So if we write down each one and try to take each one individually, it makes it make more sense. Okay. And that's what I did here at first, why I tried to pull out and I broke it down into those transactions and put the dollar amounts with them for what we need to do. So what do we need to do? First, on September 1st, we had the purchase of $3,750. That goes into inventory. Okay. It said we purchased it for cash, so we credit our cash account. Okay. If, for example, those were purchased on account, we would make that in accounts payable. So that was our first transaction. Also on that date, for that purchase, we were responsible for the shipping cost. The shipping costs were $150. Those $150 again become part of our inventory. So our inventory, being an asset, gets debited to increase it by $150. And again, we paid out cash, reducing that asset by $150 to pay the freight cost. Okay. Also on that date, we received some more inventory on a different truck. Okay. And this was for the sneakers that came in. So we increased our inventory by 10,000. And it was on account, so we would have credited our accounts payable here because we were getting credit terms on this one to pay it later. On September 10th, we paid $5,000 within the discount period. Okay, so we paid $5,000. See right above it, we created an accounts payable up there for $10,000. So now we paid $5,000. We can take the $5,000 off. Okay, since we are within the discount period, we are not going to pay the full $5,000. We are going to get a 2% discount. Okay, That discount comes out of inventory, so that's why your inventory you see is being decreased by $100, which is the $5,000 we're paying off times the 2% discount that we are receiving. And then the cash that is actually going out now is $4,900. Okay, so that is how paying within a discount period, okay, we pay lower cash and we lower the amount of our inventory. Okay. On the 25th, we return some goods. Okay, we still owe for them. Okay, it is still in that accounts payable. So we're going to debit that accounts payable, that liability, to make it go down. Okay, and because we're not going to pay it because we are sending it back. Since we are sending it back, okay, it is no longer going to be part of our inventory. So we credit our inventory to make it smaller, making that asset go down. And then finally, we owe $4,250 left on our bill. When we decide to pay it, we just take it out of our accounts payable with a debit entry and we credit our cash, and there's no discount to worry about because we are outside of the discount period. So those are your simple purchase transactions. Okay. That wasn't a simple question because it had all of them mixed into one. Okay. But when you break it down, each one of those 6 transactions and just kind of logically think about where they're going, hopefully it helps it make more sense. For sale of inventory, okay? We recognize sales revenue when it satisfies its performance obligation, okay? And it says, and the collection of cash is reasonably assured. Well, if we're making a sale, most of the time it's going to be on a credit, debit card, cash, so it is reasonably assured. And if we did a credit large sale for a vehicle or some kind of farm equipment or anything like that, we're probably going to do a credit check before we actually make the sale. So the collection of cash is going to be reasonably assured there. So we're going to go with when it satisfies the performance obligation. Okay. Remember, from receivables, when we make a sale, okay, a lot of times we are going to be debiting that accounts receivable if it's going to be owed later. Okay, if it's made by credit cards or by cash, we're going to record cash like we did in chapter 4. Okay, with inventory, we need to make a second entry. Okay, we're going to record our sales revenue and our cash or our accounts receivable or whatever it may be. Okay, but we also need to record an increase in an expense of cost of goods sold and a decrease of inventory going out, okay, with a credit entry. So there's always a dual entry when it comes to sales. So on August 1st here, Brandon Shoes sells football cleats to a local football team for $12,000 cash. Okay, then it says what each pair was sold for per pair. That's kind of, well, okay. Brandon paid $10,000 or $100 per pair for the cleats from its supplier. And on August 15th, they returned 10 pairs of cleats for the cash refund. Okay. So for our journal entries here, on August 1st, we need to, they paid cash for it. So we debit our cash. It increased by $12,000 and the sales revenue went up by $12,000 because that is what we actually sold those for. Okay. Also on that date with that exact same entry, it's a dual entry. These two always have to be made. We debit our cost of goods sold. So we have an expense of $10,000 because that's how much it cost us to buy those shoes. Okay. We had that in our inventory for stuff to sell. Now that it's gone, we take it out of our inventory with a credit. So real quick, what is our gross profit here on this sale? Our revenue minus our cost of goods sold. So we made a gross profit of $2,000 on this sale. But they decided to return some. Okay. So when we had those shoes come back, okay, the 10 shoes, we sold them at $120 a pair. So we need to lower our revenue, okay, by 120 times 10. or $1,200. We also got to give cash back to them because we are giving them a refund because they paid in cash. We're giving them a cash refund back at $1,200. But now we need to put them back into our inventory also. Okay. So they're only valued at $1,000 for our inventory because that was the original cost that we had paid for them. Okay, the 10 pairs at $100. And then we need to actually lower our expense. Okay, we need to take it out of cost of goods sold since we took it out of revenue. Okay, so now we had a gross profit of $2,000. Now, if we think about it, after the return, our sales revenue dropped from 12,000 to 10,800. Our cost of goods sold went from 10,000 to 11,000. No, went from 10,000 to 9,000. Right, so then we have 11,800 minus 9,000, $2,800 gross margin, I believe. I write that out. I probably did that math wrong. All right. So that's it for video one. Okay. Going to be able to identify the difference between a perpetual and a periodic system, and then record for purchases and sales of inventory under that perpetual system. Handouts 1 and 2 have practice examples of each that you can watch those videos and go through, but they also have practice examples on the inventory costing methods, which we are going to talk about in the second lecture video for this chapter. So you're going to need to watch that video before you can try to do both parts of the handouts on either handout 1 or 2. So I look forward to talking to you in that video.